Chapter 6. Shareholder Capital. The key points in this chapter are: shareholders represent an outflow of money at some point in the future because they want whatever is left over from the assets less any liabilities due. Shareholder capital is made up of the opening shareholder capital at the start of the financial period, the balance down figure, financial performance in the period plus sales less expenses, the net of any payments to or from shareholders. Movements in shareholder capital transactions can be confusing. There are two major points of confusion. If credits are bad, why are profits not debits? Students can start from a point that credits are bad because they represent money going out of the company in this some point in the future, and that debits are good because they represent positive money. Profits are considered good, and therefore profits, sales, by paying money into the company, are good and must be debits. However, credits are simply minus money and represent an increase in money going out in the future to anyone, including shareholders or a sole trader, or a reduction in money in the future. Sales represent the company making money that will ultimately be paid to shareholders, which is money going out to somebody, the shareholder or sole trader. Therefore, sales equals credits because this money will be paid eventually to shareholders. A sale represents an increase in the liabilities of shareholders and minus money, and that at some point will go out to those shareholders. Expenses represent costs that will come out of any amount that we pay to shareholders. Expenses therefore are debit plus money because they represent a reduction in the money going out at a later date. If the shareholder pays more money into the company, they will want that back in the future, plus any profits less any loss. So this is going to be an increase in future money out item and a credit entry. Drawings or dividends, money paid to shareholders or sole traders, represent an amount that is now not available to pay to shareholders at a later date. They've already had this money, and is therefore a reduction in money out in the future, and therefore is a plus money and a debit. What accounts make up total shareholder capital? Shareholder capital is made up of the opening balance on the shareholder account, in the shareholder capital account at the start of the financial period, financial performance in the year, which is plus income, sales, less expenses, purchases, rent, electricity, wages, etc., plus any payments to or from shareholders. At level 3, you'll see at the end of the financial period, the movements during the financial period, points 2 and 3, are transferred to the shareholder capital account for the start of the next financial period. As a result, in the question to create, you're going to have an opening balance question. So in the question to create a trial balance, as you sort of seen in chapter 5, the shareholder funds becomes the difference between the other debits and the other credits, where this shareholder capital figure isn't provided. If it is provided, you'll need to check that your debits equals credits, otherwise your answer is not right. Most often it won't be provided, and this is a check to see whether you can understand the accounting equation, whether assets equals liabilities plus capital. But how would you get to the capital? Well, it's the difference between the debits and the credits.